Morning and welcome to 5 Before the Bell, TheStreet.com's global market update and U.S. market preview right here from the central London studios of Core TV in the heart of the financial district of central London. I'm Martin Baccardax, London Bureau Chief here at TheStreet.com. I'm going to take you through those 5 things you need to know before the bell as we do each and every day. And as we do each day, we're going to start in Europe, although that is not where the news commenced. Effectively, what we're looking at right now is a pullback on stocks in and around the region that followed a little bit of wobble in Asia. Last night, as I'm sure you have seen by now, North Korea fired its second missile in as many weeks. It landed about 2,000 kilometers past the coast of Hokkaido, the northern island of Japan, after traveling about 3,700 kilometers. Provocative launch, celebrated by Pyongyang, and of course condemned by the region and the United States, who says now that North Korea is definitively in breach of an agreement it signed just a few months ago with respect to proliferation of potential atomic weapons. Of course, this comes just days after the UN Security Council increased sanctions on the country as well as a result of the saber rattling in the region. Curiously, though, Asia shares actually did relatively well. The broadest measure of share prices around the region was up about 0.1% by the end of trading. And actually, the Nikkei closed out its best week in about a month, and just under 20,000 is where the benchmark was priced by the time we got to the end of the day. Now, Europe was a little bit weaker when we first started as a result of what people were seeing in North Korea, but actually it started to accelerate a bit more, I believe, on the back of what seems to be another depressing terrorist incident here in the City of London. Fulham is an area just to the west of the city, and one of the district line stations there on the London Underground is called Parsons Green. This morning there were reports of a fire on that train, and it turns out that police have declared it a terrorist incident, and the BBC has reported only moments ago that the potential bomb that was placed on the train that caught fire had a timer, had wires, and actually was set to cause significantly more devastation than it already did. Police have said 18 people were taken to hospital with injuries, some of them serious, as a result of burning. There was clear and understandable distress from the incident around the region as a result of the fact that it came not only on a commuter line, but probably at the busiest portion of the commuter time in Europe's biggest and largest city. So it's a depressing story. It reminds us once again that the terrorist specter hasn't gone away. And again, it pushed European stocks and certainly the FTSE 100 deeply into the red. That said, the larger part of the reason for the decline in the FTSE 100 is linked to the UK pound. The pound surged to its highest level against the US dollar since June 23rd of 2016. I beg your pardon, June 24th. The reason that date is significant, of course, it's the day that Britain voted to leave the European Union. The pound collapsed overnight as a result of that, and it stayed collapsed for most of the year, but it's starting to climb back. And again, we've printed the largest and highest levels that we've seen since that vote. What's the reason? Faster inflation is certainly part of it. Consumer prices rose at a 2.9% clip last month. That's the fastest pace in 5 years. Yesterday, the Bank of England made no changes to its base rate, as we reported, but it hinted that rate hikes could come further if the economy were to continue on its path of improvement and if inflation weren't to subside in the coming months. Now, those are two massive ifs, as far as I'm concerned, because the British economy is teetering on the edge of recession if it isn't able to get consumer spending back on track, and the data doesn't seem to suggest that, at least at the moment, and until the country can iron out an agreeable and workable transition from the European Union. That said, inflation is likely to continue to accelerate, although slow a little bit as a result of the pound's rise. So maybe, just maybe, the Bank of England's verbal intervention is doing enough to lift the pound, stem the tide of inflation, and not necessarily have to raise base rates when the economy is in such a fragile condition. Now, the reason that it's worth noting the pound's rise and the FTSE's decline is the fact that the FTSE 100 here in the United Kingdom is comprised of companies that earn the bulk of their revenues outside of the United Kingdom, 75% by some indications. So therefore, when the pound increases, the value of those overseas revenues decline. So there's almost a lockstep inversion between the pound's rise and the FTSE 100's fall. It's always worth to keep a very close eye on those two dimensions if you're a North American investor with money invested in the UK stock market through an ETF or whatever, because they are going to move in that inverse way, and therefore you will have to become a central bank watcher in the very near future in order to make sure that you're ahead of those moves. What I find curious as well, and I wrote a story that you can see on TheStreet.com today, is the fact that global central banks seem to be finally converging and telling us that the era of cheap money is over. I do beg your pardon. Do you believe it? Hard to say. Global economy is only growing at a 3.5% click, and it may slow into 2018 if the recent data from China is any indication. But nonetheless, central banks are worried about the fact that we have been living on low rates for too long, and asset bubbles are growing as a result. So keep an eye on that. Certainly keep an eye on the Bank of England in the months ahead. But note now that we are trading at the highest levels for the pound since June of 2016. Moving on to the United States, and Google is facing a lawsuit that alleges sex-based discrimination on pay and says that it has stymied the career path of women who have worked for the tech giant in California and elsewhere. The lawsuit was filed last night by 3 former employees, relatively senior, it must be said, and it is on behalf of all women who have worked for Google at the company's locations in California for the past 4 or 5 years. Again, they say that equal pay for equal work is not in place now at the company, and that career paths have been changed and altered as a result of expectations for achievement based on sex or gender. Now, the company denies this. They say that pay and hiring decisions go through a rigorous screening process that has multiple levels, and therefore it doesn't agree with the central premise of the lawsuit. But it didn't reject it entirely. And it does make one wonder if there are some concerns about the culture within Google that are taking that have reached the higher echelons of the firm. You'll remember that in 2015, the Department of Labor looked at a statistical analysis of the way that women were paid inside the company. And what they said was that systemic compensation disparities were in place by looking at 21,000 different pay scales. And therefore, they felt that whether or not it was conscious, there were certainly discrepancies in the way that women and men were paid differently inside the company. It's also worth noting that about 70% of the company's employees are men, 80% of its engineers are men, and the company has been embroiled in accusations of treatment issues and sex-based discrimination in the past. In fact, you'll remember over the summertime, a former employee unveiled a memo in which he described in very disparaging and quite frankly insulting terms the intellectual incapacities of women with respect to work in the tech field. It's perfectly ridiculous. It nonetheless caught the traction of social media and therefore became a news event. The employee was fired, subsequently rehired, and the company was rehired by someone else, not Google, it must be said, but the company was forced to face this allegation. Microsoft and Twitter have both been at the receiving end of lawsuits that have based very similar allegations with respect to gender discrepancy on pay. Uber, of course, you'll remember, has really yet to come back back on top from allegations earlier this year levied with respect to corporate culture, inappropriate comments, a kind of a macho sort of override with respect to the way that management treated employees, particularly those women who worked for the company. And of course, it led to the ouster of the founder and CEO just a couple of months later. So Silicon Valley is not inured to this, and in fact, it's becoming increasingly frequent that we are talking about the culture in these companies and the way in which women are paid allegedly less than their male counterparts. The story isn't going away. The stock hasn't moved as a result of it, but nonetheless, this is kind of headline risk Google would like to avoid, but nonetheless, it's back in the news today. We're going to move on and talk about Oracle. We're going to stay within the sector, however, because the tech company's stock is called sharply lower in pre-market trading, down a little bit more than 4% the last I looked, despite the fact that they beat Wall Street estimates with their first quarter earnings last night. Their quarterly numbers are a little bit different. The first quarter ended at the end of August, and they posted 62 cents a share, a little bit better than Wall Street had anticipated, and they beat soundly on the top line with revenue growth of 7% to $9.2 billion. Great number inside there, and probably the most important in this story is the cloud services division, where revenues grew 51% to $1.47 billion. And they're growing, they're becoming a larger part of the company's overall revenue and therefore increasingly important. But the pace of the revenue growth is starting to slow, and Oracle basically told Wall Street last night that their current quarter projections for revenue in the cloud services are going to be lower yet again, probably in the range of about 39 to 43% in terms of growth. Still very, very good, but slowing from the 51.5% and slowing from the 56% in the quarter prior to that. So the trajectory is a little bit troubling, and that's a big part of the reason why that Wall Street is trimming their assumptions for prices going into today's session. Now, it's probably worth noting as well that the stock is up 37% so far this year. A little bit of profit taking is never a bad thing. But I'm interested in this story from a couple of perspectives. Firstly, Oracle, of course, has been touting the cloud services growth. It says it's going to hire 5,000 people, take on Salesforce, and this is going to be the new and most exciting aspect of its business suite going forward. Yes and no. It's certainly true. There's a lot of competition out there, and Oracle isn't alone in the space. And therefore, the way that it is going to be able to maneuver operating margins in that space, I don't think is going to be nearly as robust as some people are pricing in. And I do believe that that's playing a factor in the way that we're seeing the shares react today. It's also indicative of, I think, of the pace of growth in the overall tech sector and in the overall corporate sector of the United States, because more and more of their activities are directed to these cloud services as we exchange data in ever-increasing amounts. So the fact that they are seeing slower growth certainly could be a result of the increased competition, which affects margins, or it could be a result of their interpretation of how quickly the business is going to grow, and that could be a barometer of U.S. corporate growth. Difficult to say exactly what it is, but investors aren't taking any chances, booking some profit right now, and as I say, the stock is called about 4% lower as we head into the opening bell. Okay, let's take a look at what is happening on Wall Street as we approach the start of trading. The Dow Jones Industrial Average is actually holding up really nicely. It's only called down about 2.5 points right now, so that's about 1/10 of 1%, and we're also looking at a little bit of trim for the S&P 500 and the tech-heavy NASDAQ. We'll get retail sales data today. I do think that's going to be important, particularly when you consider that we had slightly faster than expected inflation in the month of August, and that has ignited some speculation about the Fed's rate increase later this year. Goldman Sachs, in fact, published a research note that said it didn't believe that the destruction caused by Hurricanes Irma and Harvey would delay the Fed, and they've actually boosted their assumption of a December rate hike past the 50% range. So it is now more of an increasing probability that we will get that one more rate hike. When you certainly look at it in concert with what the Bank of England is telling us about rates and the anticipation of policy tightening from the European Central Bank, you do get a more collective sense that central banks are working in a coordinated manner. This assumes, of course, that global growth continues to advance. But as I say, there are some signals that that isn't the case, particularly in China, but also elsewhere. We'll just have to watch it and see where it heads. But at the moment, at least, it does seem that Wall Street is shrugging off the concerns with respect to North Korea. Hopefully, it is looking in a thoughtful manner at what's happening here in London and around Europe, and we'll see where the trading takes us through the end of the day. That is it from me today and for the week from 5 before the bell here in central London and the Core TV studios. I'm Martin Baccardax, London Bureau Chief at TheStreet.com. Have a great weekend, guys. We'll see you on Monday.